All right, let's pray and get going. Heavenly Father, we thank you for Monday. We thank you for sunshine. Please be with us today. Help us to understand some of this difficult material and be with our families and keep them safe and wherever they are. We ask these things in Jesus' name. Amen. All right. I still have not figured out, and like you, I didn't have time to get to it. I'm going to try and get to it tomorrow to try and figure out what was up with that problem from chapter 7. Being that we need to move on to chapter 8 and get this one under our belt. So chapter 8 is how we deal with translation of foreign currency financial statements. Typically you're going to have one company that owns another company in a foreign country. For example, U.S. Japanese corporations like Toyota, Subaru have foreign operations here in the United States. And those all have to be brought home at some point and consolidated on a single financial statement. And you're going to have to, when you have countries, divisions or companies that are multinational companies operating in different currencies, those all have to be brought into a single currency at some point. There are basically two methods to use it. We will go over each one. I am still trying to figure out what entirely the difference is between them because they don't get you the same result. Okay? Both are acceptable. I guess you use whichever one you think meets your needs better. But anyway, we will talk about them both, and we got a couple of problems. I've also put a video on the thing that might be useful to watch. It's probably a 20-minute or so video by that Blair Cook person, not the Bruce Marshall, but the Blair Cook. Bruce didn't have one on this one. And so you can watch that and see if that brings it into balance. I did. No, maybe I lost that. Yeah, I took that off. I'll find that at some point. But I was trying to Google around to saying, is there a brief statement that would basically compare and contrast these two methods? I sort of had one that was getting close. But it's, you just say this chapter is probably going to feel a little bit complicated. Hopefully with some practice at it, we'll get good at it. So foreign operations with their accounting in a foreign currency require translation into U.S. dollars in order to consolidate the financial reporting, or whichever currency you're needed to go from. So to translate a foreign subsidies financial statements into U.S. dollars, we use the historical exchange rates, those which existed at the time a transaction occurred. This one will be current exchange rates, is the exchange rate which exists at the balance sheet date, and average exchange rates are the average exchange rate over a period reported on. So try to get these. I don't have historical. Go. All right. The use of different exchange rates during translation means the resulting financial statements will okay, so if you just take them from one set to another set, those they would not balance. So to force the statements to balance, an account called, and this one is the translation adjustment, is debited or credited. Harry, have you covered this topic?
Yeah. But I guess it's different though. I don't know why.
Part of Puffy, right?
Yeah, part of the fun. They emphasize a lot on where to record those adjustments.
Right. They don't
Yeah.
spend much time there. They just tell you that that's where they're at.
Yeah, that's right.
And I think that's what I remember about it too, going through the CPA exam experience, that a lot of what the details of what we're talking about here, I didn't see on the exam.
Oh.
I did know that a lot of it is another comprehensive income. That is, you know. Okay. So assets translated at a current exchange rate when the foreign currency is appreciating, increasing in value relative to the US dollar, generate, what would that generate?
Positive.
Positive. And when the foreign currency and this would be a credit entry. Liabilities translated at an exchange rate when the foreign currency is appreciating generate negative translation. Obviously, that's going to be a debit entry. And it says here, balance sheet items translated at current exchange rates change in value from one balance sheet to the next and are exposed to translation adjustments. Balance sheet items translated at historical exchange rates do not change in value from one balance sheet to the next and are not subject to balance sheet exposure. So the net asset balance sheet exposure exists when the assets translated at current rates are greater than liabilities translated at current rates. So we have two methods, the current rate method and the temporal method. So we use the current exchange rates to translate all assets and liabilities. And we use historical or average exchange rate to translate equity accounts.
So spot rate is historical?
Do I have something wrong on that?
No, I'm just... Is it the same thing? Historical?
Spot rate would be current.
That'll be current?
That would be the spot rate if you're talking about use the current exchange rates to translate all assets and liabilities. I think that would be the spot rate, right?
I don't know.
The spot rate is what we're talking about, what it is right now?
Yeah.
Yeah.
Okay. Okay.
So use historical or average exchange rate to translate income statement accounts. The temporal method uses historical exchange rates to translate assets and liabilities carried at, obviously it's the historical cost. And we use the current exchange rates to translate those carried at current cost or future value. And we're still in the temporal method here. It uses historical or average exchange rates to translate equity, revenue, and expense accounts. And the objective is to produce a set of financial statements as if, this is in the temporal method now, as if the foreign subsidy had actually used that exchange rate, that currency all the time. So if we have if we're a U.S. company and we have a foreign subsidiary, what we're trying to do is pretend, basically, that all the transactions were done in dollars. And they were done. So that's the idea of the temporal method. All right, translation of retained earnings. In the first year of operations, when you would have no beginning retained earnings, translation procedures are as follows. These are taken from the translated income statement. Foreign currency net income is taken from the translated income statement, and the dividends are times the historical exchange rate on the date of declaration. And of course, at the end of the first year of operations, the ending retained earnings from begin 1 becomes the beginning retained earnings for year 2. Now the translation of cost of goods sold. For the current method, we're going to use the weighted average rate for the current period. Now the reason for that is we likely are going to want to, if we have more transactions, 5 times as many transactions in October as we do in July, we would want to, we wouldn't want just to use an average. We would want to make sure that we got the weighted average from the time of when the transactions were actually occurring. So the temporal method, we want to decompose cost of goods sold into its component parts and translate each part using the appropriate rate. So beginning inventory, we would use the historical rate. For purchases, we would use an average rate. And ending inventory, we would use the historical rate. make sure you apply the lower of cost to market using foreign exchange rates. Here you go, Harry. Just that is the spot, also known as the current rate as of the balance sheet date. So that's just for the translation of fixed assets and accumulated depreciation. You want to translate those using the spot or current rate as of the balance sheet date. And translate depreciation expense using the average rate for the current period. Temporal methods, the fixed assets are acquired at different times and will be translated using the historical translation rates. Accumulated depreciation uses the same historical rate as the related assets. Translate depreciation expense using the various historical rates related to the underlying cost. Underlying assets. So in other words, if we buy the asset at a rate, when we acquire that asset, we want to continue to depreciate it at that exchange rate at which we acquired it at. We don't want to change the, start depreciating at a different exchange rate just because it might make us look better or worse. All right, so gain or loss on the disposal of property, plant, and equipment. Translate the gain or loss using the historical rate in effect on the date of the sale. We're using the temporal method. The cash received times the current rate, the land cost times the historical rate, is equal to the gain/loss. And the difference is, that's how you're going to get to the difference on that. Now I'm trying to get my mind around that. We don't revalue the land. That makes sense? I guess that sort of makes sense.
You can see what they're doing. It does seem like you'd revalue the land a little bit, though.
I guess it captures the whole gain or loss, right? At the kind of
because then you
smashes them all into one transaction. Otherwise, you
yes, then you'd have cash or accounts payable. Okay, yeah, that makes sense.
Okay. All right. What to do with these translation adjustments? If you're using the current method, it's going to be on the balance sheet under
accumulated and the comprehensive income.
AOCI, right?
Mm-hmm.
or is it just OCI? Which obviously turns into AOCI, right? Translation adjustment is reported on the income statement. If you're using this, if you're using the temporal method as a translation gain or loss. So the criteria for using the current method or the temporal method. Why would you pick one or the other? Since both are acceptable, by the way. These are the two main methods out there. Pretty much worldwide, these are the two methods that everybody uses. So that subsidiaries that do most of their transaction in US dollars, temporal method applies. Subsidiaries that operate relatively independent or are self-contained from their US parents are going to use the other method. This blank here is the functional currency. Determination is used to decide whether the foreign subsidiary is integrated with the U.S. parent or self-contained. A company's functional currency is the primary currency of the foreign entity's operating environment. So these are some indicators. Indications, so these are indicators. In cash flows, indications that the functional currency is the foreign currency. Primarily, cash flows, primarily in the foreign currency and do not affect the parent's cash flows. If the sales price is not affected on a short-term basis by changes in the exchange rate, if the sales market is an active local sales market, if the expenses are primarily local costs, if financing is primarily denominated in the foreign currency and the foreign currency cash flows adequate to service obligations in intercompany transactions, as there's a low volume of intercompany transactions that are not extensive in interrelationships with parent operation. So this is indications that the functional currency is kind of self-sustained. So are you reasons that I guess you're going to use the current rate, right? I'm taking that correctly? Applies to local currency perspective. Subsidiaries that operate relatively independent of that are self-contained from the parent. All right, indications that the functional currency is the parent's currency, and I'm guessing all the opposite of the previous list. Okay, cash flows are directly impact the parent's cash flows on a current basis. The sales price affected in the short term basis by changes, is affected on a short-term basis by changes in the exchange rate. But the sales market, mostly in the parent's country, or sales are denominated in the parent's currency. So, what kind of business would you think of when you saw that? Maybe a manufacturing facility in a foreign country, but all the sales are done in the parent's country. Could be a reason that this kind of exists. Expenses, primarily cost for components obtained from the parent's country. Financing is primarily from the parent or denominated in the parent's currency. And intercompany transactions, there's a high volume of intercompany transactions and extensive interrelationship with parents' operations. I have no idea if this is a right or wrong example, but your Apple computer, making a guess, which one do you think that they might use?
I think the functional currency is US dollars.
Probably is.
Yeah.
And what might be the determining factor on that? Other than its home base is in San Francisco.
Because in North, well, US is still the #1 market.
Number one market's here. So
Yeah.
I don't know what percentage we make up of Apple's, volume, sales volume, as compared to everybody else, or.
And I think like 70% of their retail stores are located here. 60, 70, I'm not sure. Yeah, but majority of the retail stores are here.
So are there any other companies you can think of where it's pretty self-contained? I don't know if this is fact or fiction. I'm just suggesting that maybe Coca-Cola might be the opposite, where Coca-Cola makes beverages custom to individual taste and preference in all kinds of countries. Hundreds of Coke products that are never seen in the United States that Coca-Cola makes. All right. So the answer, the highly inflationary economies which method do you think is going to get used?
Current.
This is temporal. So it says if the current method were used, the U.S. equivalent would be very small due to rapidly increasing exchange rate. give us an example here of the current rate method. The Pawn Company is a wholly owned foreign subsidiary of King. Pawn's transactions and financial statements are denominated in local functional currency, the potter. Is that a real currency? Look it up.
I don't think so.
You don't think so? Okay. Heard of that one yet. Use the following information and translate their statements into US dollars. Pawn's common stock was issued in 2002 when the exchange rate was $1 to 1.2 potters. The fixed assets were acquired in 2003 when the exchange rate was $1 to 1.1 potters. As of January 1, the retained earnings balance was translated at $350,000. Inventory was acquired evenly throughout the year. Okay, so that's always going to be an indication of how you're going to do that. When was the inventory done? The December 31 translation adjustment had a debit balance of $69,841. Dividends were declared on March 15, and equipment was sold on October 1, 2012. And here are the following exchange rates that were in effect during the year. And they also gave you the weighted average rate there, which you're probably going to need for, I'm guessing, for the possibly some of those. So here we go. Now we're going to take, here's Pawn's income statement. And I looked at the possibility of taking this thing out and so you could type these in. It just seemed a little more complicated to get all these deleted.
Mm-hmm.
So I left them in. There's your sales. And all right, I'm just making sure that I understand this. That's the sales, or see, they're going to use the weighted average there. The cost of goods sold is using the weighted average. And the operating expenses, we're going to use the weighted average. And the gain on sale of equipment, let's see. Getting that from? I'm looking for the gain on sale. Is that something, did I miss something?
Is it just given?
Oh, how do I know I use October 1? That's my point.
Was sold on October 1. Equipment was sold. It's on the second to the last.
That's just given information?
Yeah.
Okay. So we notice here that we have net income of 90,000 potters, and it turns into $107,354. There's our retained earnings in dollars. No, that's in the foreign currency there, how that relates to dollars. And the net income is in 90,000, so that's 107,354. We subtract the dividends. There's the dividend date of declaration. So where that's going to be, the date of declaration was March 15, 2012. 0.86, so that's where that comes in. So your retained earnings are going to be updated to that amount there, 410,842. So as you can see, it's not just a real simple thing as, oh, here's the retained earnings, let's bring it over across, slam, bam, thank you, ma'am. No, it doesn't work that way.
That would have been nice though. I'm still waiting for an accounting for it to just be like, you take this and you always multiply it by this number and you always do this and you're fine.
So sometimes I wonder if we make things up to make our lives more difficult so that nobody else can do our job. Therefore, we can charge more money for what we do.
Job security.
You wonder why the tax code is as complicated as it is? I can guarantee you that the American Institute of Certified Public Accountants had something to do with that.
Or wants to keep it that way.
And if you believe, they might even be Freemasons or something up there, some secret society up there. Now here would be an interesting, has anybody ever done this research project, looking at all the accounting fees that are derived from all public accounting companies? What percentage of them are related to tax? I'm sure it's huge. Okay, so here we keep going with this. We have, this is still Pond Company. The cash is, here it is, 35,000. We're bringing that over at the current rate, right? Receivables are coming over at the current rate. Inventory is coming over at the current rate. And fixed assets. I'm not following that one. Is that right? Make sure I'm leading you guys down the wrong Yes, translate fixed assets and accumulated depreciation using the spot rate as of the balance sheet date. Translate depreciation expense using the average rate for the current period. So liabilities, we bring across at the spot rate. Common stock, that is the historical rate, right? When the stock was issued. And the retained earnings, we got that update because we just did that. And so we have a translation adjustment there of a negative $111,353. The translation adjustment is the difference between the net assets and the current assets in the net asset at historical rates added to the translation adjustment balance at the beginning of the year. So this is how they came up with that. $41,511 plus $69,841 is equal to $111,352. Where did those numbers come from?
I think the 69, that's the balance.
Where at?
The 69, that was the previous balance.
The previous balance?
I think the 41 is a plug.
The difference between net assets at current rates and the net assets at historical rates added to the translation adjustment of balance at the beginning of the year. All right. Now, to keep going, we're going to have to switch gears and open up the Excel sheet that I sent you. So you should have 1, 2, 3, 4, 5, 6 tabs on your Excel sheet. So the first 2 tabs are the information, okay? So we're now going to do the temporal method. At least I think that's what we're doing. Oh, crud, you're kidding me. I didn't. Thank you very much, Dr. Troy. Life is good. This is not the same problem, is it? Hmm? Email her and see if she can provide us that before our next class period. Let's go ahead and use this problem. I've got the solution to it, so we won't get too far off track. Now what I've got in these 2 tabs over here are the answers, okay? So what I did was I took the 2 tabs and I kind of washed them so we could So this is the temporal method, and we're going to take the debit or credit in, I guess these are going to be pesos, and these should change and then we're going to have to put in the correct exchange rate that we have. So I have these, and I also have the exchange rate on this page. The additional information has the exchange rates for the different things that we're going to need. Right, so accounts payable obviously does not have a debit balance, so we'll put a 0 there. What is, go back to the ledger, and we're going to find the accounts payable is, we're going to turn from this peso. And I think this is a Canadian company that owns a Mexican company. Compliments of the North American Free Trade Agreement. You guys ever watch any of that history or look any of that is the great fallacy that things were going to be so much better after we. All right, so that is the current rate of the accounts payable. 35 pesos. I think it's what, 0.35 pesos per dollar. Accumulated depreciation. This is 19,000. Buildings and equipment. It's at 40,000. Now the historical rate on this one they give us is 0.25. That is right here. Acquired when 1 peso was worth 25 Canadian cents. Cash, we have 59,000 pesos. And we're going to use the current rate of 0.35. Depreciation expense, 2,000, and that's based on the historical rate of the assets. Our inventory. All right, we want to begin. Let's look at the ledgers here. Do they give us that information, or do we? There we have it, the beginning income statement. We have the ending. And we have the purchases. Okay. And looks like the weighted average rate there is 0.34. The beginning inventory, we're going to take that at the historical cost, right? And that one is 0.3. That's what it started out at the beginning of the year. I don't know why they call that credit there. Isn't that kind of cost of goods sold?
Is book it into inventories.
That's the out, right?
Mm.
So that's going to be at the weighted average. What's going on there? Oh, would help if I used the correct decimal place. And the inventory on the end of the balance sheet, this is also 28,000, and that's also going to be at the weighted average. Purchases, 68,000 pesos, and that's also going to be at the weighted average. Receivables. We're going to use that. That's going to be the spot rate. The salary expense. We'll use a weighted average on that. And our sales.
For the salary, let's see, salary expense. It's weighted average, right?
Did I do that right?
It's 0.34.
Should be 0.34, correct. So, you kind of got to get an idea of why you use weighted average, why you're using spot rate on any of these, and why you're using historical on these. So that's. And I don't know what main office means. And this got taken out accidentally. There's a remeasurement here, and there's supposed to be a $10 credit there, or debit there. And that gets us, notice that that gets my debits equal to each other. All right, so can I figure out my net monetary assets or liabilities in pesos as of the first of the year, 1/1/2011?
Nope.
Huh?
Nope. Impossible.
It's not possible?
It's given.
Let's see. Did they give it to us? Oh, it's equal to ledger F37. There it is there. So that is total monetary assets is equal to B34. There's your cash, there's your monetary, and there's your so you're basically your current assets minus your current liabilities. Really what it comes down to. So your net monetary assets are 31,000, and we're going to all right, why am I doing that? I'm working it backwards, right?
Those are accounts receivables.
This is as of the end of the year. So I'm pushing,
yeah.
This balance here, net monetary assets, is as of 12/31/2011. I need to find out what it was at the beginning. So I'm going to reverse everything. If it's a sale, I'm going to subtract it. If it's an expense, I'm going to add it back. So I get up with, I have a negative 16,000 as of 1/1/2011.
So that's an asset?
No, that's a net monetary liability. That's the net. If it was positive, it would be an asset. If it was negative, it's a liability. So anyway, that's where we started at. Okay. And what was my exchange rate on that date? Looks like it's 0.32, right? And what is my increase in monetary assets? Well, that's my sales. I'm going to use the weighted average decrease in net monetary assets are my purchases. Also add a weighted average. And our salary expense, also add a weighted average. And our net monetary assets are going to be, should be the sum of these, right? 31,000. And again, you just can't, be nice if we could just take that total and bring it across and be done, not have to go through all that, but anyway, that's where we're at. So that is there, and now our net monetary assets at the current exchange rate. Which is 0.35, is 10,850, and there is your remeasurement gain and loss of $10. Not necessarily coincidental that that's the same number that's up there. So that's where we're pulling that from. And this number here, this main office, that's also here. That's this number here that they've given you, the Mexican main office account, the equity account on 12/31/2011. That's the equity balance that's sitting on the parents' books. I didn't scrub these out, so the income statement. Now that we have everything in student G16. Is equal to G16. G16. So there's the sales there. There's the this is the count here, and it looks like we've got the this is the main operation of Canada here, okay? So we're going to take this information plus this information that we've exchanged, and we're now going to produce a consolidated income statement. So that's your total in Canadian dollars, and it's all expressed in Canadian dollars. And I guess now, looking at that, these are all going to be now, so they're all Canadian dollars, and we can also translate those into US dollars. You wonder how many times this gets rolled up. If you have a company that's like 6 layers deep, and you gotta, and it's owned by, and it keeps, you know. Isn't there a movie called that, Lost in Translation? Um, so just looking at those arrows, you just want to pay attention to see where those are going from. And there's that cumulative translation adjustment. Notice where that arrow is pulling into. All right, that took 10 minutes less than I thought it was going to. So I'm going to get a few short homework problems up tomorrow. I will also start getting the tests for chapter 7 and 8 up tomorrow. So you guys you'll be looking for that. Probably sometime tomorrow noon. And if I can remember, I'll email you and let you know that it's up and running. But we'll come back and we'll work some more examples on this on Wednesday. And keep flying. And if you do have a chance, try to watch Mr. Cook's video. He's highly entertaining to listen to. It's almost as sarcastic as Jason is.